Every time you turn on the news, there's a different headline about interest rates. The Fed officials warn that more rate hikes are needed if inflation returns. Trump says that U.S. interest rates are at least 3 points too high. Mortgage rates spike to 7.25. Housing market braces for impact. These type of headlines are everywhere. But here's the truth. There's a lot of people that have no idea what interest rates actually are or why they even matter. Listen, if you want to build wealth, buy a home, invest in real estate, then you have to understand how interest rates actually work because it impacts everything. How much house you can afford, how fast your debt grows, how long it takes to reach financial freedom. So today I'm breaking it all down and we're going to go slow and simple to understand the basics and then we're going to build from there. This is Investing 101. And by the end of this video, you'll know more than 99% of people about how interest rates really work and how to use it to your advantage. Let's be honest. Most people go through life borrowing money, using credit cards, taking out loans for school or a car or a house, and they never actually really understand how interest works. It's like we all missed the day in school where they explained it, assuming that your school even taught it at all because mine didn't, when the truth is, no one should be handed a high school diploma without understanding this stuff, interest rates, or just money. But here's the deal. Interest is like fire, and if you don't know how to handle it, you can get burned. Listen, it's made me millions of dollars, but it's also ruined other people's financial futures. So in this video, we're breaking down what interest actually is, why it exists, and who controls it. Once you understand interest, you're going to start seeing how the entire financial world really moves. In diving in, this is how I've made millions of dollars. Buckle up, let's go. So here's the first part. What is interest and where did it actually come from? Interest is not new. It's been around for thousands of years. Ancient Mesopotamians tracked it on clay tablets. The Greeks and the Romans used it for trade and expansion. It's been around that long because it works. And let me show you. You see, interest is all about lending and borrowing money. Let's say that someone needs cash today, but they don't have it now. But they know that they're going to be able to pay it back later. So they go get someone who does have the money, and they basically say, I need to borrow this. Now, maybe your mom or your dad would lend you some cash for free, but most other people are going to ask, why should I lend you money? And what's in it for me? And how do I know that I can trust you to actually pay me back? That's where the interest comes in. The borrower says, if you loan me this money today, I'll pay you back all that money plus a little bit more. Well, now they've got the lender's attention. Now there's a reason, an incentive for them to say, okay, I'll lend you the money because I'm going to make money on the money that I give you. Let's say that I'm borrowing $100 and I promise to pay you back $110 for the use of this money. The original amount is $100. This is called principal. The extra money, that extra $10, that's called interest. You see, now the lender isn't just doing you a favor. They are actually making money on their money. And there's a whole bunch of people out there with money that they want to lend you as long as they're going to earn enough interest to make it worthwhile for them. Now, it gets more complicated when you start specifying timelines on when it needs to be paid back or how and when the interest is going to get calculated. But in a nutshell, that's the basic concept. The lender loans the principal amount, they receive back the principal plus interest. And by the way, this idea of earning money with money, it's the foundation of almost everything in modern finance, also for you to eventually become financially free. It powers mortgages, credit cards, student loans, car payments, business loans, even the national debt. It's how banks profit, how investors grow their wealth, and how borrowers get access to money that they need now. By the way, if you want to borrow some money from me and I think that you're risky to lend to, I'm going to charge you high interest. Or if you take the US government and other countries like China are basically giving America money for its debt, they know that America is not going to default, that they're going to pay them back. They can always print more money, so they get a very small interest rate. All right, now let's talk about different types of interest because they don't all work the same. First, let's talk about how interest is calculated. The two big categories are either simple interest or compound interest. Simple interest is calculated only on the original principal. So if you borrow $1,000 at 10% simple interest, then you're going to pay them back $1,100. It's 10% of $1,000, which is $100. Compound interest, on the other hand, it means that the interest keeps stacking over the passage of time. You pay interest not just on the principal, but also on the interest that's already been added. So if I borrow $1,000 and my interest is compounding at 10%, then maybe in the first year, I'm gonna owe you back $1,000 plus the $100 of interest. But in the second year, it's now $1,100 that's earning interest. And the next year, it's gonna be more. So compounding interest over the long haul actually ends up producing more interest. Let me give you an example to help you wrap your mind around this, because the math gets a little bit crazy really quick, and it takes a financial calculator to be able to calculate compound interest. Let's take the example of credit cards. They have compound interest, and most credit cards compound daily. By the way, not weekly, not monthly, not annually, daily. So if you put $1,000 on a credit card with a 25% high APR, the annual percentage rate, well, that interest is going to compound daily. And then here's what happens. The daily interest rate is roughly 0.0685%, which is 25% the annual interest divided by 365 days. That means that every single day, your balance grows a tiny little bit based on that day's total. Well, after 30 days, your original $1,000 principal balance is now $1,020.75, even if you don't spend another penny or don't make a payment. Now, it doesn't seem like too much now, but if you're only making the minimum payment, the interest is actually going to keep growing, and it's going to keep accumulating. And this is why banks love lending interest on credit cards to people that they feel are credit worthy. Now let's continue with the same example, because if day zero starts at 1,000, we're now on day 30, where it's $1,020.75. What happens getting us to day 60? Well, by day 60, it's now $1,041.94, which is $22 additional to the $20 from month one. In other words, it's stacking. By month 3, your balance is $1,063 a month. By the 4th month, your balance is $1,085. By the 12th month, after a year, it's $1,278.85. Now pause. Remember that we talked that this is a 25% interest. If it was simple interest, at the end of the year, it would have been $1,250, because 25% of 1,000 is $250. So it would have been $1,250. But with calculating that interest daily, it's not $1,250, it's $1,278.85. That may not be enough for you to be like, dude, what's the big deal? It's literally only $28, $29 more dollars by the end of the year, but we're only talking about $1,000. What happens if we talk about a car that's $50,000? What happens when you talk about a house that's $400,000? Compound interest makes the bank a lot more money than simple interest. Hey, sorry to interrupt, but this can't wait. What I'm about to share could literally be the missing piece that you've been looking for. Give me just a moment, and then I'll get you back to the video. It's gonna be worth it. Listen, you don't need a whole bunch of side hustles. You don't need a fancy business plan. You need clarity, and the kind that produces wealth without wasting your life chasing it. If you wanna build passive income and start hitting 6 and 7 figures without burning out, click the link below, get this book, read it. Believe me, there's millions of strategies out there, but only one that gets you there faster, cleaner, and with your sanity intact. Bottom line, this term APR, it's a little sneaky, because if we say that you owe 25% interest on $1,000, like I said, it's an extra $250. But if it's 25% APR, where it compounds and it's not simple interest, it's an extra $278. If you're young, for example, and you're getting your first credit card, I want you to understand this, because there's a reason why my first mentor told me, get an additional 2 credit cards. I want you to have 3 of them, and then I want you to keep them paid off, Kris, because all I want to do is show the bank that you're being responsible with your credit. So after 2 years, they can say, hey, Kris, you've established your credit history. We're now willing to lend you money at a larger scale on a house, because you've shown us that you're responsible. Now, going back to credit cards, some get really risky and high with like a 36% APR. It's insanity. It's how the credit card companies make a lot of money with this tricky, sneaky math, which is why I always tell people, stay away from consumer debt. By the way, let's hit this for a second. Consumer debt is bad debt because it costs you money. Business debt is good debt because it makes you money. One word debt can be really bad or really good. Credit cards, if you're using it to just buy more stuff and afford a nicer lifestyle or buy things you can't afford yet, you're going to pay for it with that sneaky little tax. Ultimately, that's the danger of compound interest when it's working against you, because it can quickly drain your accounts. And you feel like it's free money, but boy, do you pay out the ears and nose for it down the road. But that's not the only type of loan out there as well. There's other ones. Let's talk about some of the most common types. Let's talk about car loans, auto loans, right? Let's also talk about student loans, because they tend to be more stable. They usually come with fixed interest rates, meaning the rate doesn't change over time. And if car loans are 4 to 10%, student loans are usually between like 5, 6, and 7%. And then there's another category, which is one of my favorites because I make a lot of money with it. Let's talk about mortgage rates, right? That's kind of what's big in the news right now, is what are interest rates on homes? Well, these are typically lower than credit cards or personal loans because the loan is backed by collateral. This house has value. It has equity. That's what a home can provide. And banks know that over the last 65 years, that on average, nationwide, homes go up an average of 4.65% year over year over year. So they know that the longer you have that home and the more it goes up in value, the safer their collateral becomes. Because if you get in a pinch and you can't make your payment and it's like, we got to sell the house, here's the good news. The house has gone up so much in value, I can sell it, get out of my pickle, and still have a pile of money. What this does is it ultimately lowers the risk for the bank, which means that they don't have to charge you as much interest, so they keep it lower. So let's talk about home loans for a second. They do function with compound interest. They're not simple interest, and they have different kinds of loans, right? There's one where you've got fixed rates, where basically the rate is gonna stay the same for the life of the loan. If you're doing a 30-year mortgage, then your interest rate will never change. Once you sign, the rate that you got, it's locked in either until you sell the home or you refinance the home. Other mortgages have variable rates, which means that they can go up or down depending on market conditions. And the big question is, who decides what these rates actually are? Well, it's actually more complicated than it seems, and that's what we're getting into next. You see, the Federal Reserve and how they influence interest rates across the entire economy is ultimately who's going to determine what those interest rates look like. So going back to the headlines of Donald Trump, who's like, rates are 3% too high. He's leaning really hard on the Fed chair saying, we need the Federal Reserve to lower these interest rates to make homes more affordable for people. But ultimately, the Federal Reserve is the one who sets the rates across the board. Let's talk about who's pulling the strings behind the scenes. Because believe it or not, there is someone who is setting the tone for the entire economy. Who's doing that? It's like I said, it's called the Federal Reserve, or we call it the Fed. Think of it like the central bank of the United States. It doesn't set the rate on your mortgage or your credit cards directly, but it does control something called the federal funds rate. And that one number affects everything. Here's how it works. The federal fund rate is the interest rate that banks charge each other to borrow money overnight. Sounds weird, right? Like, why would banks even need to borrow money from other banks? Well, banks are required by law to keep a certain amount of money in their accounts at the Federal Reserve. But depending on how much money they've loaned out that day, they might come up short. So they borrow money from another bank that has extra money on hand just overnight to make sure that they meet this requirement. It's kind of like your friend spotting you gas money just until your paycheck hits tomorrow. It's short term, it's behind the scenes, but it keeps the whole system moving. And while most consumers never really hear about it, this one little rate, the rate that banks charge each other for these overnight loans, it drives the entire show of what you're experiencing financially in your life. Because once that rate changes, banks adjust all the other rates that they offer you. If they have to pay more for the money they borrow, then they most certainly are going to pass that expense onto their consumers in the form of interest rates on their loans. Your credit card, your savings account, your auto loan, they all shift to keep pace. Now, what I'm about to tell you next is really critical, because I just want to back up for a second and just tell you, when I bought my very first home as a real estate investor, I bought it with a basement apartment. I rented out the basement and it covered my whole mortgage because I had a variable mortgage and I was paying the least amount of interest possible, and that worked for my situation. I'm glad that I understood this, because a year after owning this home, I borrowed money from this home, the equity in it, with a different kind of loan called a home equity line of credit, and I used that to pay my down payment on my second property. Now, I was able to make a payment to the bank on that interest of $1,000 a month for the mortgage, but I was charging the people living in the home $1,600 a month. So I was making $600 extra a month. It was like I was a bank, and this is why you need to pay attention to this, because if you can figure out how to arbitrage interest rates, that means I'm getting a loan at this interest rate. I have found a way to sell it to someone else at a higher rate. I'm the dude in the middle making the money in the middle. That's called arbitrage. So let's get back to the Fed. When they raise that internal bank rate, borrowing gets more expensive across the board. The goal? to slow down spending and cool off inflation so that things don't keep going up in value. But when the Fed lowers the rate, it's trying to stimulate the economy and make it easier for people and businesses to borrow, invest, and spend. Lower rates equal more activity. By the way, do you remember the financial crisis of 2008? Like, homes had gone up so much in value, and then all of a sudden there were too many homes and not enough people, and there weren't people to buy the homes, so literally the economy collapsed. And then after a few years, the government's like, this is crazy. We need to stimulate the economy because we have all of these extra homes, no one's spending money, no one's doing everything, we're gonna collapse. What did they do? They lowered that rate as low as they could, where it felt like for a decade that money was free. It's like interest rates were like 3% when it's normal for them to be at like 6, 7, and 8, kind of like they are right now. And people remember a decade of really cheap money. Well, the government did that because they were trying to stimulate the economy, saying people buy stuff, because if you'll buy stuff, the economy will get moving again. It's like the Fed has a giant thermostat. If the economy is overheating, prices are rising too fast, they can turn the dial up. If things are slowing down or heading into a recession, they can turn it down to boost the system. But here's the part that matters to you. When the Fed makes these moves, banks respond immediately, and your credit card APR can adjust within weeks. Auto loan rates, business financing, savings account returns, they all shift. And while mortgage rates aren't set by the Fed directly, they're heavily influenced by what the Fed does, because it signals how the broader economy is doing. This is also the reason why I'm always looking for the Fed's announcements once or twice a quarter on what they're going to do with interest rates. Because right now, if you ask where are we at in the economy, Donald Trump is saying these rates are too high. We need to lower them to stimulate the economy, to get the economy moving. I think President Trump wants to see real estate moving. But do you know what happened once they lower those rates? The price of real estate is going to what? It's going to shoot up. And when it increases in value, it's going to make people money because, hey, my house has more value. I have more money to spend. That's going to stimulate the economy. It's going to excite people for saying, wow, because rates got lower, my mortgage is less. We should go buy a second home, or we should finally get that home because we've been renting that we've been waiting for, and it's going to stimulate the economy. A lot of people are suspecting, based on what Trump is saying and the pressure he's putting on the Fed, that interest rates are going to be lowering the second half of the year, and that's going to help stimulate the economy. So when you hear the news say, the Fed is meeting this week, or the Fed just raised rates again, that's not background noise. That's your money being affected in real time. So whether you're buying a house or using a credit card or you're saving for your future, the Fed's decisions shape the rules of the game. I told you that mortgage rates work a little bit different. Let's talk about them, because a lot of people think that the Federal Reserve sets mortgage rates directly. That's not quite how it works. Mortgage rates are influenced by the Fed, but they actually follow a different path. You see, mortgage rates are more closely tied to something called the 10-year Treasury yield, which comes from a type of government bond. A bond is basically a loan that you give to the U.S. government. You're lending them money, and in return, they promise to pay you back later with a little bit of interest. And by a little, I mean it's not a lot, because the government has a history of paying their people back. On average, a 10-year Treasury bond produces a return of 2 to 3% per year over the long run. So we're not talking a ton of interest. Personally, I do not invest in bonds because I'm focused on higher return investments like the game of real estate. But banks, insurance companies, and big institutions, they got so much money, they care about these bonds because they're looking for a certain amount of safety with low risk. Because the mortgage market is also long-term and lower risk, lenders look to the bond market as kind of a benchmark. And that's why mortgage rates tend to follow the yield on these bonds very, very closely. Now, don't get confused. If you were to look up Treasury yield at the time of this video, it's going to be around 4.5%. But mortgage rates are like 6 to 7%. So what's the deal? Well, historically, mortgage rates are about 1.5 to 2.5% above the 10-year yield. That difference covers the bank's risk, operating costs, and profit margin. Remember, banks are a business, not really an institution, kind of like hospitals. They're a business, and banks want to make money on every loan that they give. Back during the pandemic, when mortgage rates were sitting near 3%, the 10-year Treasury was literally between 1 and 1.5%, not 2 to 3%. So what then determines the 10-year Treasury yield? Well, essentially, it's confidence. Here's how it works. When people get nervous about the economy, like during a recession or a major crisis, they want safety. So what do? They buy more government bonds. That drives demand up, and when demand goes up, the yield goes down. On the flip side, when people feel confident about the economy, they move their money into things like stocks, business, or real estate. That lowers the demand for bonds, which causes the yield to then go up to incentivize more people to invest in them. Now, if you want to buy a home or be a real estate investor, which by the way is why a lot of people subscribe to my channel, they're looking for that investor knowledge and information. You don't need to fully understand the bond market. You just need to know current mortgage rates and really how they impact you. The last thing that you need to understand mortgage rates is this. The bank also takes your personal circumstance into consideration when approving you for a loan. When you apply for a mortgage, here's what they want to know. Your credit score, meaning how creditworthy you are, your loan amount, and then your down payment. The loan type, whether it's fixed or whether it's adjustable, the length of the loan, is it a 15-year mortgage or a 30-year mortgage, and how risky you actually look to the lender. All of these things are going to impact the rate that you personally get or whether they're actually going to lend you money at all. Which is why I always tell people, keep your nose clean, be smart with your credit. It's a value when you're qualifying for things. If you've ruined your credit, go get some credit repair and work on it. And know that if you're hanging out with Uncle Kris, I'm always going to show you how to buy real estate and invest in real estate without needing credit at all. Okay, the last thing that we need to talk about then is how interest rates shape the market and why I don't let them stop me from doing whatever I'm doing to build wealth. By now, you can probably see why interest rates shape the real estate market, right? They determine how much house you can afford. Even a 1% difference in your mortgage rate can change your monthly payment by hundreds of dollars. And over 30 years, that adds up to tens of thousands of dollars more or less that you can essentially qualify for. So when rates are low, more people can qualify for more loans. Their monthly payments are going to be cheaper. The demand for homes goes up, and that demand is what drives higher prices, which is why I'm telling all of my investors, buy real estate now while interest rates are high. I've been buying real estate for the last 3 years, and a lot of people have looked at me and they said, why are you doing that? Shouldn't you be waiting for interest rates to get lower? And I come back and I say, it's a cycle. Interest rates are going to come down. I can always refinance. I can always lower my rate, but I'm buying because the price of real estate is down. What's going to happen when those rates drop? The price of real estate is going to increase. So here's the answer to why I'm still buying real estate. Interest rates are not my only consideration when buying investment properties. When you look at the money you're going to make as a real estate investor, the interest rate is going to determine how much positive cash flow you have a month. But if I can buy when rates are high, I'm going to buy a house at a lower price compared to what it's going to be later. Guess where you make more money as an investor? Do you make more money on your positive cash flow or the final exit price you sell the real estate for? Well, if I'm buying real estate right now for, let's just say, $50,000 less than it's going to be when rates drop a couple years later, that's $50,000 more. That's literally 50 G's that I'm basically getting on top of all my other profits because interest rates are not the most important consideration. All they're doing is managing how much positive cash flow I have. You see, I'm investing based on whether the deal makes sense, not what the interest rates actually are. And the truth is, a lot of deals still pencil right now, even with higher rates. Those are the deals I'm looking for. And if you're following the right model, you can always be investing in the game of real estate. My model, it's simple. I buy below the median home price by about 30%. So your national median sitting around 430 grand, and my average home that I'm buying is around $250,000. And these are the smarter homes, the entry-level homes where there's a greater demand. These are markets also that have very strong appreciation. They have solid rent demand, and they've got long-term population growth. I'm not gambling on luxury properties or hoping to flip something in a shaky market. And while most people only look for deals in their own backyard, I invest nationwide because there's 324 markets, and the top 5 markets are going to make me easily double as much money as investing in an average market. I have access to teams and properties in markets most people have never even really heard about, but places where the numbers work way better than wherever your backyard is. So yes, interest rates do matter, but if you're only investing when they're low, you're going to miss out on most of the money I'm making in the game of real estate. You're going to be missing out on opportunities left and right. Real estate, it's a long game. It's not a short-term interest rate game. And if you have the right strategy, you can literally win in every single market. By the way, if you're curious about the markets that I'm investing in and how you could literally access those homes or partner with me to do all the work for you, I've got information in the description. Click the link. Let me show you how to do it. Check it out. I bet you know more about interest rates right now than you probably wanted to, but you're definitely walking away from today's video with a lot more knowledge. And ultimately, how interest rates are important and how they impact everything in your world based on what you can afford or how fast your debt grows or how your investments perform or whether or not the deal in front of you actually makes sense or not. Most people, they never learn this stuff. So I want to congratulate you for hanging with me to get this information. It can be a little bit boring, but you hung in there and you did a good job, right? Most people, they're just going to sign the dotted line. They're going to hope for the best, but not you and not me. We now know what to look for, and we know how to use this knowledge to make smarter, more informed decisions. So whether you're a first-time home buyer or whether you're a seasoned investor or you're just looking at getting in the game, understanding interest rates is going to give you an edge that most people never get. For example, now you can actually move on real estate instead of everyone else that's saying, oh, wait for the rates to drop. You're going to lose money playing that game. And here's my final thought. Don't wait for perfect conditions. Get educated, get strategic, get a mentor, and then learn how to recognize the opportunities that are right in front of you, literally right now. They're not going to appear when the rates go down. They're appearing right now. One of my mentors said it best. The deal of a century comes along just about every single week.